Hey gang, welcome to another episode of Time in the Market, the investing channel with a long-term focus. Today I'm going to take a look at WP Carey. WPC is the ticker. This is a REIT that's down 24%. Not a surprise for REITs since interest rates are up, and that's what happens to REITs. When interest rates go up, their values of their property goes down, and their ability to finance debt at a lower rate is non-existent, which means their cost of capital goes up. We talked about that in a video not too long ago, which I'll link in the description down below. But WP Carey is unique in that it also announced a spin-off just a couple of weeks ago, and that spin-off has sent the shares tumbling even more because the market's not in love with what they're doing, and also not in love with the fact that they are resetting their dividend, which essentially means they're cutting it based on this spin-off. And that's why the stock is down another 15 bucks since then. So what is going on with the spinoff? And the timing of this spinoff is interesting. They just raised their dividend, I think in July. They also raised their dividend on 9/14. They announced another dividend bump by 2 cents, but it's something. And then a week later, they announced this spinoff and say, well, we are right sizing / resetting the dividend to a lower payout ratio based on a lower AFFO, which means a decent sized dividend cut because of this spinoff. So what are they doing? They are getting out of the office space. Their whole idea is that people do not love the office portfolio, and if they get rid of it, they are going to revalue the remaining company, which is that go forward WPC company. They're doing it in two ways. One, they are spinning off part of their assets, the part that they deem more high quality, more investment grade tenants, etc. That's about 10% of their base rent, 59 properties. They are funding this with the existing mortgage that exists on a lot of those properties, but also taking another 455 million in debt financing, and there's a cost associated with taking this debt in the neighborhood of 50 million. So that's a net negative for investors on an overall package basis. And they're getting some money there, most of which is going to be transferred to WPC. So the spinoff is not going to retain it. It's just a way to finance WPC better, which is interesting. So the spinoff is kind of going to be saddled with debt. They're also going to pay WPC, the remaining part of WPC that is not the spinoff itself, a $7.5 million asset management fee. They're also going to give them a $4 million cost fee. So it's not really a good deal for the spinoff. They're going to have a ton of debt. What they're going to be doing here is they're going to use that cash flow and any disposition, so sales of their buildings, of their assets, to repay that debt first, and they then pay distributions to its shareholders. Don't know what the long-term what they plan for the long term with this thing, which is going to be ticker NLOP, but it just sounds like they're going to wind it down eventually, pay down distributions, and kind of get rid of it, sell it, whatever they're going to do. Beyond the spinoff, which is going to be a taxable event to current shareholders of WPC, which isn't amazing. Yes, you're going to get new shares of this office portfolio. And again, office REITs are not all that well valued right now. For example, Realty Income about 2 years ago spun off their office portfolio. At the time, it was trading at 25 bucks. Right now, it's trading at 5 bucks. So lost quite a bit of money there, and it's trading at about a 4 to 5x AFFO multiple. Absolutely hated. So these guys are definitely selling low. Beyond the spinoff, they're going to sell about 87 properties, which are about 5% of their overall revenue. They expect to get about $800 million for those properties. At the moment, about half of them are sold. The other half are still being in negotiations. They think that's going to be complete by the end of 2023 with some additional sales early 2024. And then you'll have your go forward WPC, which is the company without the office portfolio, right? It's going to be mostly industrial warehouse, some retail, some self-storage, and they think it's going to be a better company, more lean, better average length of terms that they have, more favorable rate increases, better ability to grow AFFO, etc. However, in the short term, this is going to be an AFFO hit for the company. In 2023, their AFFO is going to be down about 3 to 4% from what they projected as of last earnings, simply because they are losing 15% of their annualized base rent. And in 2024, I think their AFFO is going to be even lower because remember, this 2023 impact is only for the latter part of the year. In 2024, it's going to be a full year that they're going to not have this revenue for. And because of that, they are changing their dividend policy. Right now, they are paying 81% of their AFFO in the form of dividend. Now they are resetting it to a payout ratio of between 70 to 75%, which essentially means that it's going to be about a 7 to 15% dividend cut, depending on where that AFFO payout is going to be. I think it's going to be closer to 15% based on some things I'll talk about in a second, but that's kind of my thought process. Their dividend is going to be closer to that low end, 70% end of the 2023 guidance, because in 2024, I think their AFFO is going to actually be lower. They did not give guidance for 2024 yet, simply because they don't really know what they're going to do with some of the money here. They don't know what kind of dispositions they're going to have and at the timing of the dispositions, what they're going to acquire with some of the money they're going to generate. So they're going to get, $735 million in cash from this NLOP spinoff and the cash they're getting from that debt. They're also going to take some equity forward settlements that they have, which is going to dilute them by about 4.7 million shares. So some dilution happening here in relation to this spinoff. It's not really related specifically to the spinoff, but they're just taking advantage of that to generate more money, which is kind of weird to do at this point. Just kind of makes me think that they need the money to do something, and we'll talk about what they might need that money for. They say it's going to maintain the leverage targets, improve liquidity, all of that stuff. And the spinoff is going to happen relatively quickly, on or around November 1st, 2023. And if you are interested in the spinoff and you currently hold shares of a WPC, I believe for every 15 shares of WPC you hold, you get 1 share of NLOP. So that's something to keep in mind. So this is their strategy here. This is, the 141 million in annualized base rent, the 59 properties that are going to be spun off into NLOP, 97% occupancy rate, mostly fixed escalators, mostly in the United States, 169 million in debt, 4.8% interest rate. They're taking on new debt, which is based on the higher interest rates, probably going to be a relatively hefty rate. Not sure what the length of this debt is, but if they have to refinance it soon, this could be a bit of an issue on the cost side, but we'll see. And then the stuff they're selling, about 87 properties selling for about 800 million. So decent amount of money there, but clearly they're washing their hands of the office space and trying to do something different. And you can kind of see this is what the company looked like prior to the spinoff and prior to the transaction: 53% industrial warehouse, 16% office, 17% retail, 4% storage, self-storage, and then 10% random stuff, which includes hotels, education facilities, lab, R&D, fitness, student housing, theater, random stuff like that. And now post-transaction, not even post-spinoff, once they sell all this stuff, it includes 62% industrial and warehouse, 20% retail, 5% self-storage, and 13% other. And there's going to be some office spaces, some office properties that they cannot sell, that if they can't sell them, they say that they're going to redevelop, reclassify them into other property types that would be included here, which is why they show 0%. So they're essentially shedding, 140 properties, taking in at $1.1 billion in cash or thereabouts to WPC post-transaction, and then spinning off this NLOP, which is going to hold a bunch of their mediocre office properties. You can kind of see where they are. About 2/3 in North America, about 1/3 in Europe. Their lease expirations are right here. About 40% of their leases will be up for renewal in the next 10 years or so. 60% are longer term, which is a good and bad thing. Obviously, they have escalators in there, but when leases come for renegotiations, they can potentially recapture them at a higher rate than any escalators that may exist, which may be a good thing for cash flows if they could do that. And with industrial stuff, sometimes you can get a higher recapture rate than you can with office or retail or anything like that. You can kind of see their top 10 tenants. Nothing super outstanding that jumps out at you as like, wow, this is an amazing company. But again, these are industrial warehouse properties, so they're not exactly going to be Walmarts or marquee names. You can kind of see U-Haul and Extra Space Storage, but some of these other things, you probably might not know them. It's all industrial stuff. They do have a decent internal growth profile. 55% of their rent increases are CPI linked, which is a good thing, which is why in the last couple of years, their standalone same-store ABR has been trending upwards, because CPI has been trending upwards. So You can kind of see 3 to 4% increases in the last couple of years. If CPI stays higher, that could be a good thing. But obviously, on the back end, their costs are going up just as much. The fixed side of the expense of the rent increases in that 42% range. So still quite fixed from that perspective, but it's good to see that a lot of these are CPI linked, and a good portion of them are on uncapped CPI as well, which helps to grow this ABR, which is going to allow them to grow their FFO as long as this growth is above their cost structure, grow their FFO without acquisitions. And acquisitions may be kind of tough in the near term due to their heightened cost of capital. And what's the goal here? Well, their whole idea, and this is at 9:21 at time of this presentation, their whole idea is that, well, we are 60% industrial and warehouse after this spinoff. Right now, we have an 11.9x multiple. This was at that time. Now it's closer to 10x. Well, some of these industrial warehouse REITs that are standalone industrial warehouse REITs are trading in that 15 to 18x range. Now it's closer to like 14, 16x because REITs have kept falling. Why can't we get re-rated to a multiple closer to that? That is the thesis behind this investment. Whether or not that's going to happen, who knows? They're still partially in the retail space, partially in the self-storage space, partially in the other space. And some of these retail-esque net lease REITs are now trading in that 12 to 13x multiple range. And there's other factors that cause WPC to trade at a lower multiple than some of these others. And part of that is their debt profile, and we'll talk about that soon. But the whole thesis here would be, well, right now this thing is trading at 10 to 11x their AFFO. Maybe since they're more industrial based, maybe that should be closer to 13, 14, closer to that 15 to 16x multiple that some of these industrial REITs are trading at. If you believe that maybe there's some upside here for you. I don't know if that's something that I truly buy into. These have a lower WALT. Sometimes that could be a decent thing because they can recapture things faster. And if you're recapturing at a rate that's faster than your rent increases, that could be a good thing. If you're recapturing below 100, that's obviously a bad thing. But I think these guys have done a decent job of recapturing above 102, 103%, which is what you typically get from a rent increase. So that's something to keep in mind. The good thing about this business is that it's been stable. Up until now, the reason that people have liked WPC is that it's been very stable. Occupancy has been growing. They were steady during the 2020 pandemic. They don't show stuff for 2009 and 2008, even though they said the global financial crisis here, they don't actually show it. So it makes me feel a bit weird about that. The good thing is that during that period, during 2008, 2009, they did keep raising their dividends. So this has a 25-year history of raising their dividends. So they are about to become an S&P 500 dividend aristocrat. So them cutting their dividend during this spinoff is kind of weird because they lose that dividend aristocracy, which is valued very highly in the dividend community. So that's why people are like, well, what's going on here? What is the problem? And I think it's kind of obvious what the problem is, and we'll talk about that in a second. It's their debt. It's really their debt and what their debt means for their business on a go-forward basis. So if you look at their debt, they have a bunch of it, and they think that they're going to use some of this extra money to deleverage a bit, but also improve their liquidity. And when you kind of look at some of these metrics, well, net debt over EBITDA of 5.7x is very good. It's not terrible by any means. If you look at their EBITDA over interest paid, it's also 5x plus, which is what you want to see. So on paper, the debt doesn't look that bad. The problem is that the average debt maturity is very low, right? They are going to have their debt mature pretty dang soon. And they're going to go from an interest rate that's very favorable at 3.3% to something quite a bit higher in the next couple of years. And that is a bit of a concern when you look at how much operating cash flow they generated in excess of their dividend before they reset this dividend, before they kind of did this spinoff. They settled their equity forwards. They made these sales to raise and sort of make their capitalization a bit more powerful. Because if you look at this is not amazing, right? They have 1.4 billion, almost 1.4 million in debt maturing in 24, nearly 2 billion in 25. nearly 1.6 billion in 26. So in the next 3 years, 60% of their debt is going to mature, and it's going to go from interest rates that are in the mid threes to mid fours to probably mid sixes, right? So you're talking about a 300 basis point increase on their debt, given what you're seeing in the interest rate markets right now, which is not a great thing. If you think about, let's say they have to refinance 3 to 4 billion on this debt in the next couple of years at an increase of 300 basis points, that's 90 to 120 million in annual interest payments above what they're paying today, right? So if you think about, well, that sort of sucks, that's going to have a direct impact to your AFFO. On top of that, on top of the fact that your cost of capital is going up a lot more given where your stock price is right now and given where your debt's going to be, they're in a bit of a pickle here. And that's kind of why I think they're doing a lot of what they're doing with their dividend. You can kind of see that when the stock price was at 53.63, this was about a 10.2 to 10.3x multiple, depending on the low or high end of their 2023 AFFO target. And if you think about what they're doing, they are resetting the dividend to 70 to 75% of AFFO. That means that the dividend is going to go from 4.276 annually to anywhere from 3.6 to 3.9 annually, depending on what the low end or the high end of that target. And that's anywhere from a negative 7 to 15% reduction in their dividend. And the reason I'm saying I think it's going to be closer to the 15% low end is because I think their 2024 AFFO could potentially be lower than the 518 to 526 that they're projecting for 2023, because they are losing 15% of their base rent. And the 2023 impact is only on the back end of the year, right? It's only on October, November, December, depending on when they sell those assets, when they spin off some of the assets, etc. As you go into 2024, those assets are gone for the entire year, right? So you already see a negative impact to the AFFO just for those 3 months. What's going to happen when you look at the entire 2024 year? So if they say, well, the dividend is 70% of the 2023 AFFO and AFFO goes down a bit in 2024, that number might start approaching, 72, 73, 74% of a lower 2024 AFFO number. And they didn't give guidance or an AFFO yet, but that's just my thought process. Obviously, they are getting $800 million from selling some of the office properties. They're getting $700 million or so from that equity forward agreement and from the debt that the spinoff is giving them. So maybe they can use that to acquire new properties, but they also have this debt overhang that they have to handle. So probably they're raising some of this money to sort of pay down this debt so that they're not suddenly facing an additional 60 to 120 million in interest payments, depending on how much they have to refinance. So it's going to be a combination of these two things. So personally, for me right now, I have no interest in owning this, at least until post spinoff. I don't want to deal with the tax consequences that may come with that issuance. And I think that NLOP, because of the debt it's being burdened with, because of the properties it holds, doesn't have that much value. If you look at OLN, the spinoff from Realty Income, it's down like 80%. It's trading at a very low multiple. The market just hates office properties for a variety of reasons. And while this may eventually start giving you a dividend, it's only after they pay down that debt. So this dividend here, this 7 to 15% cut that I'm projecting, does not account for any additional dividends that NLOP may offer. And remember, one NLOP share will be issued for 15 shares of WPC held, but that dividend probably won't come for a while until they pay off that debt, until they start disposing of those properties. And who knows what the long-term potential of NLOP is. It might just wind down in a decade or so. Now, NLOP is also paying WPC a fee, and it just doesn't seem like it's all that enticing because WPC is kind of just throwing it to the side and burdening it with a lot of debt. Now, the valuation of WPC at 10x might seem enticing post spinoff, but I think that reevaluation thesis that says, well, we're going to be an industrial property REIT now, we should get a 12, 13, 14x multiple, that might take a while to spin off, right? They're going to have a lot of debt refinancing that's going to be at the forefront of the next couple of years that may push AFFO further down because suddenly you're looking at an additional 60 to 120 million in interest payments that are going straight to the bottom line. On top of that, your 2024 AFFO is uncertain because you don't really know the timing of the spinoff dispositions, what they're going to do with the cash if they acquire new properties at good cap rates to improve AFFO, or if 2024 AFFO is going to be lower than 2023 AFFO because it's a full year of spinoffs. And also, it may just take them more time to start growing again via acquisitions, as their cost of capital is going to be quite high, right? They are looking at a 10% AFFO yield. So if they have to issue new shares, it's not a good time to be issuing shares. Now, cutting the dividend can actually improve their cost of capital because on a yield perspective, it costs a bit less to offer new shares from that perspective. So that's not a bad thing. And on top of that, cutting the dividend also gives them a bit more operating cash flow with which to work with. I kind of looked at, well, if they currently pay 934 million in annual dividends, assuming the equity forward additional shares that are going to be issued, about 4.7 million in dilution that's going to happen there to raise that cash. And the new dividend on the low end is going to be about 792 million. It's an additional 142 million in cash flow that they're going to have. And that cash flow, one, is probably going to cover the additional interest that they have to make, which may mean that it doesn't impact their AFFO as much if they can pay that off faster. Two, they can pay off their debt faster with that cash flow, or they can use that money for acquisitions. That is the cheapest cost of capital is your own free cash flow. It's worth 0%, right? If you have to borrow at 7%, if you have to issue equity at 9%, or you can use cash flow that costs 0%, what's the best way to do it? It's to generate more cash flow. So as they're thinking about this on a go-forward basis, as they're thinking about, well, how can we grow AFFO on a go-forward basis? We need more cheap cost of capital. The way to do that is to reduce the dividend, both from a cost of equity perspective, but also from a way to generate operating cash flows to fund those acquisitions. But even with that in mind, it's going to be tough for them to grow really quickly, really soon because of that huge debt overhang. So really, NLOP doesn't have a lot of value to me. And I think post NLOP, I would need this thing to have a really good valuation. I'm talking sub 10x, and I would probably build a position slowly because there's just a lot of weird things happening. Why did they announce a dividend bump a week before they announced this? It kind of speaks to management not knowing what they're doing. It speaks to investors losing trust in management because it's like, hey, everything's good, we're raising the dividend, and then a couple of weeks later, it's like, no, never mind, we're cutting it 15%. Too bad, suckers. And they've built all of this investor belief in them by raising dividends for almost 25 years, only to throw it away in one fell swoop. On top of that, you've got all this debt you have to deal with. And another question I would ask is, why is this debt such a problem right now? We've just been through 3 to 4 years of historically low interest rates. They knew that they had these debt maturities coming up in 3 to 4 years when they were in 2020, 2021. Why weren't they refinancing at low rates and locking these low rates in at these historically low interest rates? Why do they have to now look at this in 2023 and say, crap, guys, we have 6 billion almost in debt that is going to have to be refinanced in the next 3 years, that we're going to have to refinance at 300 basis points more? That could be a problem, right? That is also something that I don't love seeing from management. And if I were them, I would have done something about it. So a lot of weird quirks here. NLOP seems like it's going to be a real turd, to be honest. I don't see how that's a good value. I mean, maybe if it trades at 2 to 3x AFFO multiples, I'd look at it. Kind of like OLN is kind of interesting at those really low multiples, but that's probably what's going to happen. And then what is 2024 going to look like? They're going to announce that during the next earnings report, which is somewhere in like January or February. So still uncertainty there. A lot of weird stuff here. Just not a huge fan. Still pays a good dividend yield, right? It's still going to be yielding 7%, close to 7% after the dividend cut, even if the dividend cut is on that 15% end, which I think it will be. There's still a lot of weird stuff here that just doesn't interest me. I mean, I do like industrial and warehouse players, but I think there's more and more of them. They're selling their office stuff at historical lows. Why didn't they do this earlier? Realty income was ahead of the curve here. Why didn't you do this 2 years ago when you could have gotten a much better valuation out of this? Just I get why this stock is down, is essentially what it comes down to. So let me know if you guys disagree. Let me know if you're interested in WPC. I'm personally not a buyer. Maybe I'll pick some up if it really starts dropping into that 8 to 9x multiple range, but then it's like, a self-fulfilling prophecy of worse and worse cost of equity, cost of capital that makes it harder and harder to grow. Right now, I think this is potentially something that is going to have AFFO growth or even negative growth for the next couple of years. And you're not going to get multiple expansion when your AFFO is shrinking, and it could shrink for a couple of years before they start growing again. So that multiple might not do what they want it to do. So let me know what you think about the video. Like, subscribe, all of that good stuff. Hopefully this was valuable. But if you disagree, let me know. If you like WPC, let me know why. If you're a buyer of WPC, let me know why. I mean, I can kind of see it. The valuation is okay. History here is decent, but it's just, is this new path forward a little too late? Is the office spinoff worth anything at all, or is it just a thing that they're using to get more money so they can pay down debt faster? I mean, it's certainly better for WPC shareholders, and not for NLOP shareholders. I think WPC is going to be a better entity after November, after this is spun off and WPC gets all this money, than it is today, because I don't really want that spinoff. So maybe then I'll take another look at it. For now, I'm kind of staying away. So let me know what you think. Like, subscribe. As always, please do your own due diligence before making any investment decisions. Talk to a qualified financial advisor, all of that good stuff. Thanks for watching. Have a good day. Bye.